In a nutshell, U.S. stocks did exceptionally well in the fourth quarter of 2019, while bonds coasted flat. Overseas stocks paralleled U.S. stocks, jumping higher. For the year, see the side box with this article, all markets are way up above averages, reversing that deep fourth quarter loss in 2018. A benchmark moderate risk portfolio, a la Morningstar's research, is up 19%, recouping its 7% loss in the fourth quarter of 2018. In the fourth quarter, the Federal Reserve Bank clipped interest rates down a third time to 1.5%, citing business uncertainty due to trade concerns and lack of inflation. Due to liquidity problems in the overnight repo market, the Fed also injected more cash, reversing their former operations that were reducing liquidity. The impact of stopping this infusion of liquidity is not yet really known. As an aside, our own Esther George in Kansas City has rotated off the FOMC this year. She voted against those 3 interest rate cuts in 2019. I was fortunate to again attend her speech at the Kansas City Federal Reserve in January and was able to get answers to pertinent questions for us. But back to business, the Fed has interest rates low and liquidity high, so remember the adage, don't fight the Fed. How about corporate earnings this quarter? Well, estimates range from up 1% to down 3%. The latter would be the fourth quarter consecutively of declines. We'll see if signing that Phase 1 trade deal with China reverses that worrisome trend. Businesses need more certainty or capital investment suffers. For all of 2019, S&P 500 corporate earnings are projected to rise 1%. That's far below 2018 23% growth. In 2020, next year, earnings are expected to grow 4% to 5%. So how did the market end up doing so well in 2019, in spite of no gains in earnings growth? Low interest rates, more liquidity, and what's called price earnings expansion. The stock market jumped to a value of 19 times projected earnings, far above its average of 15 times, which really just means investors were willing to pay more for stocks. Most pros consider the market to be fully valued here or at high levels. Can this feel-good train keep running? Oh yes. Most pros do not expect more expansion in the valuation PE multiplier, but it can happen. Corporate earnings could actually start growing again, especially if the U.S. was able to solidify trade deals with China and the European Union. We'll likely get good headlines on China, but it will be difficult to get real substance in a rock-solid trade deal with them. However, it is likely that Congress will pass NAFTA 2, the USMCA, so we get good news there with our 2 major trading partners. The U.S. consumer still drives most of our economy. We have a 3.5% low unemployment rate with a rising labor participation rate. All good indicators. What's ahead in 2020? I've read a variety of opinions. Most pros expect to maintain status quo, citing sideways action in the markets. Very few pros expect a recession. That's good news. A few analysts are optimistic and expect a good year of stock market returns. Absent our own soothsayer, it's best to diversify over different investments, avoid large bets in any single investment or type, stay invested in promising investments while focusing on solid companies and healthy, improving countries.